Oracle is at the center of this really fascinating storm right now. On one hand, you've got some of the most explosive growth numbers you'll see anywhere in the AI space. But then, on the other hand, if you take a closer look at their finances, well, you find a situation that might be a lot more dangerous than it looks. Let's get into it. So, what is this gigantic number? Well, that is the size of Oracle's current order book. We're talking about their backlog of future work, and it's being driven almost entirely by this insatiable demand for AI infrastructure. It's a truly staggering figure. So we're going to explore both sides of the Oracle story. First, we'll unpack this incredible transformation that led to that $500 billion backlog. And then we're going to look at the critical risk that's kind of hiding in plain sight, right on its balance sheet. For decades, right, Oracle was it was known as a legacy database company. But in just the last couple of years, it has aggressively pivoted to become something totally new. The essential infrastructure provider, the landlord, you could say, for some of the biggest names in artificial intelligence. Now, what's really interesting here is the contrast. You look at the rest of Oracle's business, and it's kind of chugging along with low growth. But its cloud division, OCI, is just on fire. I mean, it surged 84% last quarter, fueled by these massive deals with companies like OpenAI, Meta, and even Elon Musk's XAI. The numbers behind this bull case are they're huge. That order backlog is up 325% from just last year. They're telling everyone to expect $90 billion in revenue by 2027, and they're building these enormous gigawatt-scale data centers just to handle what looks like completely locked-in future demand. Okay, so with that kind of insane growth, you have to ask, right? What do the experts think this stock is actually worth? Let's take a look at some of the recent fair value estimates. As this table shows, there's a pretty strong consensus building. I mean, whether you look at the quantitative models from Investing Pro, the deep dive research from Morningstar, or just the Wall Street average, they all see some serious upside from where Oracle's priced today. So here's the crucial point, this gap. With the stock trading around $144, the average analyst target suggests it could be seriously undervalued. It looks like a major opportunity. But, and this is a huge but, that is only one side of the story. Okay, so the growth story is incredible, no doubt about it. But what happens when we stop looking at the future and start looking at the company's health right now through a completely different lens? This is where the whole narrative takes a very sharp turn. Let's switch gears and look at the balance sheet, and let's see how this one simple idea from the legendary investor Peter Lynch completely reframes how we see Oracle. See, he wasn't just interested in growth. He was absolutely obsessed with survival. To fund this massive AI build-out, all those gigawatt data centers, Oracle has taken on an absolutely staggering amount of leverage. And this is the big catch we mentioned at the very beginning. This is the amount of long-term debt Oracle is carrying. That's a truly enormous figure that has to get paid back, regardless of how the whole AI boom actually plays out in the long run. And this number? This is its debt-to-equity ratio. So what does that mean? It means for every $1 of shareholder equity in the company, there are more than $3 of debt piled on top. It's a key way to measure financial risk. So to put that number into perspective, Peter Lynch, he looked for fast-growing companies with a debt-to-equity ratio below 0.25. Oracle's is more than 12 times higher than that safety limit. For an investor like Lynch, a number this high isn't just a red flag, it's a blaring five-alarm fire. And this right here brilliantly illustrates the whole contradiction. When you score Oracle by Lynch's rules, it passes the growth tests with flying colors. A low PEG ratio? That's great. It means it's cheap for its growth. And that massive backlog is a huge plus. But it fails the critical safety test spectacularly, with over $100 billion in net debt and that sky-high debt-to-equity ratio. So where does that leave us? I mean, we have two completely opposite stories about the exact same company. How do you possibly reconcile them? You're left with a really clear choice. On one side, you have the fast grower narrative, a company that looks cheap, especially relative to its explosive contracted growth. And on the other, you have the financial trap, a company with a foundation that looks deeply, deeply worrying and risky. So what would a guy like Peter Lynch do? Well, despite all that incredible growth potential, he would almost certainly walk away. For him, a company's ability to survive a downturn was everything, and he viewed massive debt as the ultimate deal breaker. A strong balance sheet wasn't just, a nice to have, it was the whole game. And this is really the fundamental question for anyone looking at Oracle right now. It perfectly pits the incredible promise of the AI boom against the timeless wisdom of old-school financial prudence. So what's more important, explosive growth or a foundation that's built to last? For Oracle, well, that's a $500 billion question.